So Kev, it's time for a Market Huddle exclusive, right? Charlie McElligott's been getting all of this press with his quant analysis, and there's one particular chart that he shares that it's looking at option gamma. And now many of our listeners would benefit immensely from a primer on how to interpret these charts. And I can't think of a better guy to do it than you, because you used to be a dealer and had to deal with these types of exposures that he's talking about. And so you put together some cool slides to kind of talk about how these delta and gamma exposures work. And so let's dive into it.
Okay, let's do it. And for those that are kind of worried that we're going to talk about all sorts of Greeks and it's going to get messy and ugly,
It
this
is.
yeah. No, we're going to try to do this in a way that explains, and you're going to come out of it hopefully with the saying, I understand what Charlie's talking about. And so let's start with his chart that is kind of what's on everybody's lips. It's this, this chart where he says SPX and SPY combined gamma per 1% move in spot. And what he has is kind of various line graphs, and it shows that as the strike moves up, the gamma goes from positive, means from 0 to positive, and as the spot moves down, the gamma moves from 0 to negative. And it's just kind of a lot of people, and there's a lot of people that have kind of asked me for my advice about, like, what does he mean by this? Like, what is it? What is he talking about? And I thought it would be really helpful for us to go through how these positions are created and what they mean for the market, so that you can understand when Charlie goes and says, I think the selling is going to accelerate from here, or I think the selling is going to be capped, you understand why that's happening.
So
Sorry,
Kev,
go ahead,
isn't it
Patrick.
interesting before we go to the next chart? Isn't it interesting that the crisscross point from going negative to positive lies more or less around this kind of 28.75 level? And as we're going into Friday's monthly option expiration, where the huge amount of options and gamma exposure are rolling off, wouldn't it be interesting if that acts like a magnet for pinning prices there into the Friday close?
Well, that happens for sure. I've seen numerous academic studies that show that that often if a security is around a strike price with a lot of open interest, it is natural for that to occur, because as people sell it or roll the option, the dealers that are on the other side buy it, and then they basically, it ends up being that, we should really talk about how hedging from a dealer
Yeah.
perspective works, because then you
Anyway,
would understand why it ends up getting kind of pinned to those levels. So let's
is
go
it
through
so?
it.
So we'll go through it. It'll be just an interesting note to see whether a Friday close happens, give or take, near that 28.75 level going into the weekend. So anyway, what's going on here, Kev?
Okay, so let's go to the next slide, Patrick.
Yeah.
So I've kind of made up a scenario for people to understand. And, Patrick is he's the smart one that actually knows how to construct, option positions to take advantage of the market moves. And I was more of a market maker, and I was on the other side of a lot of Patrick's trades, and I just delta hedged them like a monkey. And we kind of put some thought into different strikes and what'll happen in terms of the volatility around different strikes. But the reality is that we didn't really care as much about constructing portfolios that take advantage of specific market moves. We were more worried about how to maintain a delta neutral book and whether we could make a profitable hedge on that. So what I'm going to do is I'm going to pretend that Patrick comes and he buys. Patrick's a big shooter, and he trades kind of like George Soros size. So he buys 1,000 SPY June 2019, 280 strike puts from me.
Okay, so we're talking the SPY, the S&P
Yeah.
500,
Right.
1,000 contracts at 280, and so I come in there we're what's it called? We're talking about 100,000 shares, right?
That's right. So it's a big position. Like that's an institutional size order. In my day on the desk, that's 1,000 lot was kind of the traditional institutional size order. So Patrick, he just tosses around 1,000 lots like they're nobody's business. So we thought we'd just kind of deal with that. So at this point, the SPY is trading at 288. Okay. So to hedge my short put position, because Patrick's bought it, I've sold it to him, I have to delta hedge. So I go put it into my model and I figure out the delta. And the delta is minus 29.72 at $288 on the SPY. Now, at this point, some people, Patrick says, well, when he does his models, he talks about the delta as 0.2972, not 29.72.
Well, that's the way it's quoted on most Greek
right. On the Bloomberg, it's quoted as 29.72. It doesn't matter. It's basically 0.2972. The question is whether your delta goes to 1 or whether it goes to 100. But it's the same. It's the same idea.
It's the same.
Okay?
So just to add and clarify for our listeners, that the delta is telling you the rate of which a option is behaving like the stock. And so a 29-cent delta on a stock means that if a stock rises $1, the option will move about 29 cents. It's telling you the rate of which the option is participating like the stock. Is that a good description, Kev?
It's bang on. For small localized movements, it's the change in the option price versus the underlying.
Right.
Okay, so I go and I short because it's the delta is 29.72. I go short 29,729 SPYs at 288. Okay, so now I've gone and
you're delta neutral now.
I'm delta neutral. Okay, so I'm immunized from small movements in the SPY. So if it goes to 287 and 3/4, it's and back to 288 and 1/4, I'm going to be okay for the most part. Okay, now let's go on to the next slide, Patrick. Okay, so unfortunately, Patrick is right, and the market starts plunging. Okay. So I wake up, and next thing I know, the SPY has moved down from 288, and it's gapped down to 284. And I know that the option aficionados in the crowd are going to say, but you could hedge it on the way down. But let's just assume that we're hedging kind of in these finite periods just to make it easy to understand. Okay, so it opens at 284, and I check my model. The delta on the puts I am short has now gone up. So now my delta is 37.28. So now if I go figure out my net,
So
go ahead,
let's stop here because you have in brackets their gamma kicking in. And so let's just clarify to our listeners that gamma is a derivative of the delta. And so the gamma is telling you the rate of which the delta is changing.
That is correct. So my delta is going... It's increasing or it's going down because of the reality is... my delta is getting larger because it's going down.
Right.
So anyway, let's just go.
Now,
go ahead. Patrick.
Sorry. I just want to clarify. Just one other thing. When a lot of people hear Charlie talking about this, one of the big exposures is going into an expiry, and the reason that is the shorter dated options have larger gammas.
That's
and
correct.
So as an option is getting closer and closer to expiration, the dealer has much bigger gamma risks.
Okay. So Patrick, you're going too far, too fast.
Okay.
We'll get there in a bit. Let's just go through this process so people understand how the gamma works and how the delta hedging works, so that we can talk about the effects. Okay, so let's go back. So my delta is now 37.28. My negative 37.28. So I figure out my net delta. I'm short 1,000 puts at 37.28, which means that my exposure is long 37,280 SPYs. But the thing is, I'm only short 29,720. Don't forget, from 288. So that means my net delta is 7,560. So I short another 7,500 at 284. Okay? So now let's go on to the next slide. So another day, and the bears are just relentless, and it's getting worse, and I wake up, and I find the SPY at 280. And Patrick is super bearish, because we know at 280, Patrick is super bearish, and he's getting really upset with the market god. He's tempting the market gods by tweeting all sorts of shit and doing all sorts of crazy stuff. So I look at my model, and my delta is now 54.88, negative 54.88. So I put it in my spreadsheet, and I realize that my net delta is 17,600. So again, I need to go and I need to sell. Okay, I need to go short some more stock. Okay, so I go short at and make another sale at $280 on the SPY. Okay, now I'm all hedged up. Everybody's happy, but then something happens. The next day, Trump announces a trade deal. All of a sudden, the S&P gaps up to open at 296. Let's go through what happens to my position. Next slide, Patrick.
Oh.
Okay, so now I kind of laugh and say, with a heavy heart, Kevin realizes the gap open will hurt a lot, because my delta on my puts has now gone from minus 55 to minus 22.
Right.
So let's go through it. I'm short 1,000 of the puts to Patrick, and then I'm short 54,000 SPYs. But the trouble is that I am now basically short 32,000 extra stock, because my delta is no longer 54,000. It is now 22,000. So I have to cover 32,000 SPYs at 296. And don't forget, I shorted at 288, 284, and 280. Okay? So I shorted at those levels, and now I'm going back and I'm buying back at 296.
So, Kev, just to clarify to our listeners, one of the things that happens here is that because the dealers have to buy more shares to close out all of their extra shorts, they're contributing to the liquidity that is driving the market even higher. So this is what creates that feedback loop of higher markets beget even higher markets, almost like it's a technical analysis event. But what ends up happening is they provide the liquidity for driving that market even higher.
That's right. So let's go through. So I was short gamma. So therefore, to stay hedged, I had to do the following. On the way down, I had to short more. On the way back up, I had to buy it. Okay? So let's just stop and think about this. The more volatile the asset is, the more I would be forced to buy and sell. So that money that I lose buying and selling is offset by the premium that Patrick paid for his put, so the implied volatility. So at the end of the day, if I sold it to Patrick for, let's say, 25 vol, and then the actual vol ended up being 20 and I hedged it properly, I would make that 5 vol points of spread. If it ended up being 30 or 35, and it's a little more complicated than this, but yeah, I would lose that. So this is the point that you kind of have to understand, is that the dealers, when they are short gamma, it's not that they're short stocks, they're short gamma. They are forced to chase the market. And when they are short gamma is when clients have bought options from them. Generally, clients are buyers of out of the money puts, and then they're generally sellers of out of the money calls to pay for those puts. And so now let's go back to Charlie's. Let's go to the next slide with Charlie's things. And he says, what's with the different gamma at different points? So let's imagine. Let's go to the next slide. Let's imagine that Patrick, because he's bearish, not only bought the puts from me, but he also sold me some 295 calls. Right, because Patrick, it's not going up. Those are going to be dust.
Oh, yeah, it's an easy way to offset the time premium for sure.
That's right. What better way to pay for your position that you're paying for the puts, right?
And synthetic short.
And this makes a lot of sense for a manager that's long stocks naturally, because that manager will find the portfolio doing well on the way up, and so they might lose a little on the short calls. But then hopefully the portfolio makes money, and then on the way down they're protecting themselves. So this is a very
it's a risk reversal.
Yeah,
it's
So let's go through the idea that Patrick sells me 1,000 of these 295 calls. Okay, and at the 288 when we first did it, the delta would be 27. So I would go and I would short 27,000 shares to hedge my long call position. But the difference is that as the stock market rallied, I would actually be selling more because the call delta would be increasing. So go to the next slide, Patrick. So the key to understanding Charlie's graph is to recognize that dealers who have different gammas at different strikes. And so at the kind of out of the money onto the upside strikes, dealers actually get long gamma. So at that point, they own the calls and they're delta hedging them around, and they hope that the stocks become more volatile. They hope that it kind of goes up and down, and they're going to make all that money by trading it around. But then as stocks decline, the dealers get shorter gamma, so where they are kind of praying that they become less volatile and that they can hedge it properly and that they don't lose too much.
Right.
Okay? So now go to the final slide here, Patrick, or that we go through. But the fact that at the short gamma that there's all these dealers that are at the lower strikes, the fact that all these dealers are short gamma actually makes the stocks more volatile because they're the ones that are hedging the positions.
Right.
So, and this is what you were kind of highlighting, Patrick, was the fact that they're contributing to the chasing the market up and selling the market down. And then on the other side, when they're long gamma, they're doing the opposite. They're actually calming down the market, and they're actually selling rips and buying dips. So if we think about Charlie's graph is very important because it shows points at which the dealers will either be making the stock market more volatile or making the stock market less volatile.
Right.
And that's kind of the most important thing to understand is that once we started to go down and once we cruise to the point when the dealers are no longer long gamma, because don't forget, when we were, if we were at 29.20 and then we went down to 2,900, the dealers would actually be buying more stock as it went lower. Because at that point in Charlie's graph, you can see they're still long gamma. So long gamma means that instead of chasing the market, they're buying the dips and selling the rips.
Right.
And then once we go to 20, what was the number? 28.75, they're neutral. So they're no longer like the gamma is not moving. And then as it goes lower, all of a sudden they're in a situation where if they have to sell the dips and buy back the rips. And that is why Charlie, try so hard to figure out where the dealer community is short gamma, because at that point they're going to be kind of accelerating, the selling. And
that means if the market goes lower, it's a short signal to go even further lower. Is that what you're saying? Almost like a technical?
Yeah. So and that's what Charlie argues is that as we go into that point where the dealers are short gamma, that the selling can accelerate. And
it's almost like technical analysis works.
It's
right?
almost like technical analysis works. That's like you're absolutely right, Patrick. But the thing about it is that you also don't forget that's why you get these rips. Because all those guys that sold down at 28.25 when Patrick was really bearish to hedge their book are now forced to buy this rally, back at 27 or 28.90.
But could you not also then extrapolate? Am I off base in making this point that this is actually a direct relationship as to why the VIX always spikes on the way down and kind of contracts the bottom end on the way up? Because in general, what happens is the contribution to volatility when they're getting on the downside of the gamma, then they're actually contributing to the volatility, and therefore the implieds will actually widen. Like they're actually exacerbating it.
That is correct. Like if the dealer community gets caught short gamma, then oftentimes it makes the actual the volatility of the stock larger.
Yeah. One of the things I've been telling my members in the last 3, 4 days is just get used to the fact that a 30-point swing in the S&P in 2 hours is just normal in this environment. Like this is not, you can't go back to like the March and April period where, 10-point ranges is the normal for a day. Like these kind of intraday moves are just actually what's happening here naturally in this environment.
Yeah, except that if we go look at Charlie's graph, and you're assuming we don't go up to 29 and a quarter, but
Oh, up there.
up at
Yeah.
29 and a quarter, there's going to be lots of dealers with all sorts of gamma to the positive, and they're going to be selling every rip and buying every dip, and that's going to calm the market
I was
down.
talking off the low in the last 4 days, right? So,
Yeah.
but you're
Yeah,
absolutely right. Like once we get up to north of 2,900, the market will calm right down.
right. And to the extent that you're bearish, if we go back down to 28.50, all of a sudden you could be right that all these dealers are going to exacerbate the volatility, and they're going to be hedging again. So
Yeah.
don't forget, they're the ones that they sold 28.25s, 2800s, and now they're going to be buying 28.75s. Now listen, the true option people that understand how this works are going to tell me that they don't hedge like as little as I put in my graph, and that it's much more complicated. I completely agree. I understand. I tried to make it
We,
simple so that I
yeah.
showed people the forces at work. And Patrick, you were the first one to mention that there's a lot of these guys have thousands of lines of this, and they're aggregating all their different positions into one, and they're trying to figure it out. And the important thing to realize is that Charlie is looking at this, and he's also making some assumptions, and I don't know exactly how he's doing this. He's making some assumptions that the dealers are on the other side of all these trades. And if we stop to think for a second and say, what if instead of somebody comes and, Patrick, you want to trade a big position, and you
Right.
want to trade, 50,000 of these things, and Kevin, I'm too much of an odd lotter. I can't fill your order. So I go, and what happens is you figure out and you get Pimco or Warren Buffett to sell it to you. Well, the reality is that they're not going to delta hedge. So it's going to behave much different. All the things that we talked about aren't going to exist,
Yeah.
because the
They're
only
taking the
reason
exposure.
that they're taking the exposure, and as it goes lower, they are more than willing to be longer in terms of their net delta. But the reason that this does exist is because dealers are on the other side of a lot of these trades, and they are trying to hedge it for every single point.
Right.
And they're not willing to sit there and go at 2,800, say, you know what, I think it's going to go back to 2,900, or I'm happy being long this. No, they're hedging every single kind of, delta that they have. Some people hedge every, X percent move. Other people hedge every hour. It's all sorts of different ways that you can go about hedging, but they're all doing the same thing. The fact is, if they are short gamma, they are selling it as it goes down, and they are buying it back as it goes up. And if
Right.
they are long gamma, they are selling it as it goes up and buying it back as it goes down. And that's the important thing to realize. That is why
Oh,
when Charlie's graphs show the gamma of I guess his best guess at the gamma of the dealer community, it helps in terms of deciding whether we're going to get kind of a runaway move in the stock market at specific spots.
all right. Well, Kev, thanks for the explanation. I think that's all of our listeners appreciate you taking a stab at this, and hopefully there adds clarity as to how some of the dynamics behind liquidity that happens in these market cycles.